For this video, I want to cover the IRS Form 8995, which is the simplified computation for the qualified business income deduction. Now, the QBI deduction can be quite complicated, but in this example, what we're going to cover is a simple scenario where we have a taxpayer with one Schedule C, and so they have an easier time at calculating their QBI and the deduction and having that flow through the return. So I do have a sample 8995 here in front of us, and it's part of the larger return. So we do have John's full 1040 here, which we'll go through, and we'll see how the various pieces flow through on the forms. And then I do have one slide here covering some of the background on QBI and the 8995, and then the other 8995A, which might apply depending on your income level. So just some of the basics for those that are not familiar with QBI. The Section 199 Cap A, as part of the tax code, was added back in 2017 as part of the Tax Cuts and Jobs Act. And so this allows taxpayers to deduct a portion of their qualified business income that's flowing through from partnerships or S corps or sole proprietorships where their earnings are reported on a Schedule C. So taxpayers effectively report the net amount of business income coming through to them, and then they get to take a percentage of that amount as a deduction. So ultimate goal here is to lower your taxable income before calculating the amount of taxes you owe each year. Now, although the computation of 20% of qualified business income sounds kind of straightforward, there are a lot of nuances and limitations that apply. So let's talk about just a couple of these here, right? So the first limitation is the deduction cannot exceed 20% of your taxable income reduced by any net capital gains. And so that's also what we're going to see in our example here when we look at John, is he's going to have a 20% of taxable income limitation. So the amount of QBI deduction is going to be reduced. The other thing to remember is only certain businesses can take this QBI deduction, right? So net income coming through from domestic trades or businesses, meaning they have to be U.S. trades or businesses with ECI, right? And that's important to highlight because, so for example, if you're a taxpayer that has an investment in a foreign partnership and the foreign partnership is not engaged in a U.S. trade or business, it has no ECI, the net income it's passing through to you as a partner, that's not going to be QBI. And so you're not going to get this Section 199A deduction. The other thing is these businesses, it's net income from the trade or business, right? So this is not going to include things like an investment income, so interest, dividends, royalties. And then the SSTB issue, so specified service trades or businesses. These businesses are generally excluded as being a qualified business. So that's kind of the standard rule. However, the exception is if your income is below certain thresholds, the income coming through from an SSTB can still get this QBI deduction. So when we look at businesses that are attorneys, accountants, consultants, financial management, service providers, things like that, they're SSTBs, and one of the greatest misconceptions is, well, if it's an SSTB, I'm out of luck, I can't do anything. And that's not true. You can still get the 199A deduction for an SSTB, but you're not going to get it, or it's going to be phased out if your income is above certain thresholds. So if it gets too high, arguably, you're not going to be able to do anything with it. The other limitation here are W-2 and adjusted basis limitations. So when we look at UBI, unadjusted basis immediately after acquisition, this is a reference to the property used in the trade or business. So if the business buys tangible property, has assets, that's the UBI limitation. Is what do you have on your balance sheet that we can use to kind of compute the limitation. So taxpayers' income is above certain limits, then these kind of other factors come into play. If your taxable income is below these certain thresholds, then you don't have to worry about these 50% of W-2 wages or 25% of W-2 plus 2.5% of UBI. And again, that's going to be the example that we're going to see here with John. is his income is below the relevant threshold, so he can compute his QBI deduction using the simplified method on Form 8995. He doesn't have to go with the 8995A. So with the 8995, we use this one, the simplified one, if our taxable income before the QBI deduction is less than these thresholds. Now, the threshold amount change from year to year, so depending on what year you're working with, make sure to look at the form instructions and see what thresholds apply for that period. So let's have a look at John's fact pattern here, and then we'll dive into the return itself. So John, taxpayer, he owns 100% of a single member LLC that's a disregarded entity. Okay, so this is not an S Corp, this is not a partnership, not a C Corp. And he conducts his consulting business through this disregarded LLC. Now, the business income and expenses are reported on Schedule C for 2022. And what John finds is that he's got a net profit of $92,200. And this business is going to be an SSTB. So the field that he's in here is a consulting field. And so that's very clearly going to fall within the SSTB kind of category. But again, what we're going to see is even though it's an SSTB, John's income is below the certain thresholds, so he can still claim this 199A deduction. All right? Okay, so let's look at the return itself. So we're going to start with John's Schedule C. So let me jump up here. So this is your Schedule C, right? Fill this out like you normally would. And so we can see that John has his gross receipts up here, his various expenses. And so his net profit before accounting for any kind of self-employment taxes or QBI, QBI deductions, $92,200. So John's starting point when he looks at the 8995 is to fill out, well, what's my qualified business income or loss coming through from each activity? So in this case, John only has one line item, right? He doesn't have any other investments in PTPs or REITs or other kind of flow-through entities. So if he had other K1s coming from S Corps or partnerships, those could be listed here. If he had any REIT dividend or PTP investments, we would see those amounts reported down here in lines 6 and 7. We don't see any of that. So his scenario is relatively simple, right? He's just got one line item for his Schedule C, tax ID number, and then the qualified business income or loss. Now note what's happening there. That number is different than the profit we saw up above. And that's because it's been adjusted by the amount of self-employment tax that's being deducted, right? So if we look at John's Schedule C, remember we have the $92,200, and the amount of self-employment tax that's being deducted here is the 6514 figure, right? So John's business income of $92,200 minus the 6514 gives us the 85,686, which is reported here on line I. So we have 85,686. This is the amount of QBI coming through from this Schedule C. So line 2, total up all the amounts. In this case, there's only one. So we've got the 85,686. We have no carryover coming through from prior year. So line 3 is blank. And then on line 5, we calculate this initial qualified business income component, right? So this is 20% of the 85,686. So that's a good start here. But now, again, remember, John has to consider what kind of limitations will apply. Well, his taxable income before the QBI deduction is below that threshold where even though this is an SSTB, he doesn't have to worry about any phase outs on that front. What he does have to worry about is the overall 20% limitation. And so John looks here to calculate, okay, I need to fill out what's my taxable income before QBI deduction, line 11, and then input any amounts that I might have from net capital gains. Well, if we look at John's page 1 of his 1040, he doesn't have any investment income. So there's no interest income, there's no capital gains. So all he needs to do is figure out, well, what's my taxable income before the QBI deduction, and then I can go forward from there. Well, the taxable income before his QBI deduction, notice the amount here is $72,736. Well, how do we get that figure? So if we go back to page 1 of his 1040, we can see here that John's total income, so his total income, he's got a Schedule 1 deduction, and his AGI is $85,686. So if we look at $85,686, and then we can deduct the standard deduction that John's taking, he's not itemizing, we arrive at his taxable income before the qualified business income deduction on line 13 is $72,736. So that is the figure that John is reporting here, right, on line 11, $72,736. And then on line 14, we have the 20% overall limitation. So 20% times $72,736 is $14,547. So this is the limit. All right, so even though John's qualified business income component, the deduction is initially $17,137, he's not going to be able to deduct that full amount because he has this overall 20% of taxable income limit that applies. So he gets to deduct $14,547, and that amount is reported up here on page 1. So line 13, the QBI deduction coming through from Form 8995 is $14,547. All right, so now John can continue on with calculating his return, right? His taxable income has been reduced by that QBI amount. So he calculates his adjusted tax and completes the return that way. So relatively straightforward example for John, right? Again, it's only one qualified business. He doesn't have any carry forwards, and he is entitled to do the simplified calculation, $89.95. He doesn't have enough income where he has to deal with the larger and a little more complicated 8995-A form. All right, so that covers it for this video. I hope that was helpful. If you have any questions, feel free to leave me a comment below. And as always, I look forward to seeing you again on the next video. Thank you.